Welcome back to the Stock Market Basics course. My name is Tom Vylord, and today we're going over section number 2, investment categories. Once again, we're not your financial advisor. We're not here to give you specific investment advice. Any company that we do talk about is to be taken as educational and illustrative purposes only. A share is not a lottery ticket. It's part ownership of a business. Peter Lynch. Here's what you're going to learn in this section today. We're going to be talking about owning investments, the advantages and disadvantages of owning investments. We're going to talk about IPOs versus secondary market shares. Then we're going to talk about the different types of stock categories, starting off with common stock versus preferred stock, growth stock versus income stock, small cap, mid cap, and large cap stocks, and finally the industry groups in which these stocks fall into. If you've ever thought about owning your own business, but you don't want to go through the hassle, long hours, and risk associated with owning your own business, then investing in stocks may be an excellent alternative. As an investor in a publicly traded company, you're more than just an investor, you are an owner of the company. And this includes ownership of assets such as their real estate and inventory. You may not have much say in the decision making and day-to-day operations of the company, especially if you own shares of a large company like Apple, but nonetheless, you're still an owner of the company. As an owner, you have voting rights. This gives you a voice in who is elected onto the board of directors and other corporate matters where shareholders get a say in what happens. Your vote is determined by how many shares of company stock you own. Corporations divide their ownership into shares of stock, and each share of common stock equals one vote. To become an owner of a publicly traded company, you need to buy shares of the company stock. A share is a certificate of ownership which represents a claim on the company's assets and earnings. And as you acquire more stock, your ownership stake in the company becomes greater. Later in the course, we're going to show you how to buy shares of stock. And these shares that you own has a price to it, which can be found by entering the ticker symbol of the stock on any financial site such as Yahoo Finance, Google, or Morningstar. As owner of any business, you get the rewards if the business does well, resulting in the price of your shares to appreciate. Owning stocks may involve higher risk than safer investments such as money markets, bonds, and CDs, but they have the potential to provide excellent returns over the long term. Here are some of the advantages of stock ownership. First, you have the potential for investment growth. If you've done your proper research, and we're going to teach you how to do that, you can find some excellent opportunities for companies whose price may increase and become worth much more than your original investment. Next is income. Some companies pay a dividend. If you're looking for current income, or if you want to supplement your retirement income, then these stocks could help you accomplish that goal. If you want to acquire more shares, one way to do that is through dividend reinvestment. So instead of taking that dividend and using that as income, you'll take that to buy more shares. It also acts as an inflation hedge. One of the biggest fears that retirees have is that they're going to outlive their retirement savings. One way that could happen is due to the rising cost of inflation. Over time, the cost of goods sold increase. The 20-year average rate of inflation is 2.4%. If we want our assets to grow over time, we need to make sure it's growing at a rate much higher than inflation. Here's a trivia question for you that you can use at your next cocktail party. And so far, nobody I've ever asked this question to was able to get the question right. Warren Buffett was asked in an interview a few years ago what he thought was the riskiest asset class. And most people would say stocks, real estate, or cryptocurrencies, or other investments where the price move around quite frequently or are very volatile. His response was not what you might think. His response was cash and cash equivalents. How can cash be the riskiest asset class? And here was his response, summarized in my own words, but cash has been the only asset class that has underperformed inflation over the long term. If you put your money into a savings account, earning 0.5% interest, and that's generous nowadays, and inflation's at 2.4%, then you effectively just lost 1.9% annually in a safe investment. And it gets better. What do you think he considers the safest investment? And here's where you might think most people would say cash is the safest investment. However, it's stocks. With all the ups and downs of the market, the crash of '08, the dot-com bubble in 2000, stocks have always rebounded. Stocks, which are also known as equities, have been the only asset class to consistently outpace inflation by a wide margin. Over the last 15 years, which includes the horrible crash of 2008, the S&P 500 has more than tripled the rate of inflation. Another advantage is passive money. You've probably heard the term making your money work hard for you. If you don't have any savings, or if you do and it's in the bank, then your money isn't working hard for you. As I just explained, money in the bank is a losing bet when you factor inflation. Passive money is when your money is working and growing for you without you having to work for it. You did do some work for it in the research process, but once that part is done, now your money is working for you while you're at work, while you're at home with your family, and your money is working while you are not. Your dividends are reinvesting to buy more shares and lower your cost basis on your existing shares. And finally, liquidity. This one's something that many real estate investors can relate to. If you have a property that you want to sell, or if you need to unload it, you better be patient. You have to do the dog and pony show, open houses, showings with a potential buyer, putting the advertisements in the different real estate listing services. However, if you have a stock that you want to sell, or if you need to sell it, you just click a few buttons on the computer and you are sold out of your position. It's a very easy process as long as the stock that you're selling is liquid, and you're going to learn about that later on in this course. Buying is just as simple. No need to have buyer's agents or attorney as you would need when purchasing any type of real estate property. To buy shares of stock, all you have to do is click a few buttons and you'll see the shares in your account immediately. However, there are some disadvantages. Unlike government bonds, there's no promise to repay your principal. Unlike CDs at the bank, there is no FDIC insurance. When you invest in stocks, there's always the risk that the value of your investment will decline in value. If you invest in stocks, a decline can occur if a negative company news event occurs, if the sector the company is in declines, or if the entire stock market is declining. Next thing I want to talk about is an IPO. An IPO stands for Initial Public Offering, or as value investors like myself, we like to say it stands for It's Probably Overpriced. When a company offers shares of stock to the public for the first time, it's called an IPO. When you purchase these shares of an IPO, you're buying shares directly from the company. After the IPO, any shares that are exchanged from one investor to another occurs on the secondary market. A secondary market means that you're buying shares not from the company, but through other shareholders who already own the shares, and they're looking to sell those shares. The exchanging of shares from one shareholder to another is done through brokers registered through these stock exchanges. The stock market is a secondary market. The stock market consists of various exchanges. Most notable in the US are the New York Stock Exchange, also known as the NYSE, the NASDAQ, and the American Stock Exchange. And the job of these exchanges is to provide a regulated market where investors can buy and sell stocks of various companies. So what determines stock prices? In its most simple terms, stock prices go up and down based purely on supply and demand. If there are more investors who want to buy shares of a particular company than there are investors who want to sell those same shares, then the price is going to appreciate. Conversely, if there are more investors who want to sell shares of a particular company than there are investors who want to buy those same shares, then the price will have to drop in order to attract those buyers. Just because the price of a stock is currently trading for its current price does not necessarily mean that is what it's worth. Another excellent quote by Warren Buffett is this: price is what you pay, value is what you get. This means that if you're buying XYZ stock for its current price, say $50, that's the price you're paying today, but that might not be its true value. Think about it this way: if you buy that stock today at $50, and next week another investor bought that same stock for $40 a share, and we're just going to assume it's a great company and it's about to appreciate beyond $50, then the investor who bought it at $40 got a better value than you did. However, if you bought that stock today at $50, and next week another investor bought the same stock for $60, then you got a better value than the second investor. Price and value are two very different things, and to be a successful investor, you need to be able to differentiate between the two. And in the next course, which you'll have access to once you complete this course, you will learn 13 different ways to determine what a stock's true value should be. And once you learn that, that is where wealth is created, because then you'll be able to know when to buy and when to sell an investment. Once you know that information, you'll be able to determine if the current price represents a fair price or if the current price represents a bargain or if it's overvalued. There are two classes of stock shares, common stock and preferred stock. When you buy shares of a company in hopes that the stock will appreciate in value, you're buying shares of common stock, also known as common shares. These have greater potential for appreciation in the share price. As such, shareholders directly participate in the success of the company. If things don't work out, they also directly participate in the failures of the company. If the company fails miserably and the company goes completely out of business, then common shareholders are the last in line to receive any of their investment back after creditors, bondholders, and preferred shareholders get paid. If there's anything left over at that point, then common shareholders will get paid back. And as mentioned earlier, common stock owners have voting rights. The next class of shares that you can purchase is called preferred stock. Investors purchase preferred stock for the attractive dividend yields and stability in price movement. Since the price movements are more stable, there's less potential for price appreciation. If the company in which a preferred stock owner has an investment goes out of business, the preferred stockholder will get their investment back once creditors and bondholders are made whole. Preferred stockholders get paid back their investment before common stockholders get paid. And these preferred stockholders do not have voting rights. The next category of stocks pertain to how the company uses its excess earnings. If a company has excess earnings, they can take the profits and reinvest back into the business, or they can pay out the profits in the form of a dividend. And these two categories are called growth stock and income stock. Growth stocks are businesses that take the profits the company has and reinvest that back into the business. This could be reinvested to purchase more inventory, technology, factories, research and development, and or acquisitions. Since most growth stocks are smaller companies, they are reinvesting their earnings to continue to grow the business. Smaller growing businesses have the potential for higher appreciation, but they also have more volatility. Growth stocks do not pay dividends, therefore investors purchase these for the primary objective of capital appreciation. Income stocks, they're also known as dividend stocks, and some people refer to these as value stocks. A major attraction here is that the companies pay a dividend. This dividend can supplement your income, be reinvested to buy more shares, and they can also lower your cost basis on existing shares. So income stocks are larger, more established businesses. Before we get to the next category, it's important to understand what market capitalization is. Market capitalization, more commonly known as market cap, is the total market value of a company's outstanding shares. Market cap is determined by multiplying the current stock price by the number of its outstanding shares. So it's a pretty simple calculation. And this is commonly used to determine the size of a company. Company A has a stock price of $50 a share and 850,000 outstanding shares. So you just multiply those two numbers together, and that gives us the market cap for Company A, which is $42.5 million. Company B has a stock price of $67.50 with 500,000 outstanding shares. Multiply those two numbers together, and you come up with a market cap of $33.75 million. Company A is a larger company based on market cap. So now that you understand market capitalization, the terms small cap, mid cap, and large cap should make sense. Small caps are companies that have a market capitalization of $300 million to $2 billion. Some brokerage firms may set their own parameters, but most would qualify this range as a small cap business. Small caps are often newer companies, but it's not always the case. Since they are small businesses, they're usually still in their growth stage. So small cap businesses have a higher potential for price appreciation. Smaller companies are not as stable in a bad economy. As such, the price movements are much greater in a volatile market environment. And since small companies are in growth mode, any profits the company earns will be reinvested back into the company. Very rarely will they pay a dividend. Mid-cap stocks are still smaller than their big company counterparts like Apple or Amazon, but they are larger and more established than small caps. The market cap for a mid-cap stock is between $2 billion to $10 billion. Since they're more established and relatively still small businesses, there are many excellent growth opportunities in this category. Mid-caps have been around for at least a few years and usually have longer track records and financials to read through than a small cap business. And mid-caps offer the potential for more growth than large cap stocks and less volatility than small cap stocks, and this is what makes this category of stock very attractive. Next are large caps. These are the big boys. These are the big companies that have market caps of $10 billion all the way up. And we're going to see market caps of $1 trillion pretty soon. The names of large caps are usually more recognizable, such as Walmart, Exxon, Johnson & Johnson, Apple, Amazon, McDonald's. You get the idea. Large caps usually pay a dividend. They're usually more stable in a bad economy. Growth potential definitely still exists here, but slower growth is more common amongst this category. Now, there's a couple other types of market caps. You have nano caps and micro caps. These are the very small companies, and mega caps are the humongous companies. But in terms of market cap, the three that investors pay the most attention to are small, mid, and large cap stocks. And finally, the last category we're going to talk about are industry groups. An industry group is a way to classify companies based on their common lines of business. Examples of industry groups would be healthcare, technology, communications, energy, banking, utilities, retail, etc. Knowing industry groups is important because as you start to build your investment portfolio, you want to make sure you have diversification. You never want to put all of your eggs in any one basket, but you also don't want to have a large part of your entire portfolio in the same industry group. If that particular industry goes through some tough times, every stock within that industry could go down. So you may think you're diversified by having 5 different companies in your portfolio. However, if they're in the same sector, then you could be exposed to unnecessary risk. Coming up in the next section, we're going to talk more about diversification along with asset allocation and other risk management strategies. Here's your learning activity for this section. I want you to find 3 companies that you're going to be watching for the remainder of this course. You're going to be adding to this list, but for now, we're going to start with just finding 3 companies. And the 3 companies I want you to look for, I want one of them to be a small cap stock. I want the second to be a mid cap stock. And lastly, the third company I want you to look for will be a large cap stock. So that's it for this section. We'll see you over in section 3. Take care.